Hello and welcome to Livewire Markets. My name is Chris Conway. Today I'm sitting down with David Lloyd. David is a portfolio manager at Ausbil and he's going to be talking to us about the Ausbil Australian Emerging Leaders Fund, which covers the small and mid-cap space. David, thanks so much for sitting down with Livewire today.
Chris, it's great to be with you. Thank you.
We're here to talk small and mid-caps, or SMIDs as they're otherwise known, often called the sweet spot. So more growth than the large cap that are a bit overvalued, less volatility than the tiny micro caps. But just talk to us broadly, after a challenging couple of years, why do you think they're still compelling right now?
I'd say through cycle, it's a very compelling part of the market for a couple of reasons, right? It's an always evolving index. There's always a lot of ins and outs. So coming into the mid caps, you have your shooting stars or the best of the best small caps, as I'd like to say. So, they're really proven. Either their product's proven, the expansion's going well, management teams are becoming more highly regarded, balance sheets are strong and well capitalised. And so you're constantly getting that refresh of new companies that come into the mid-cap part of the market. The other component, you do get some fallen angels, as I like to call them, but typically that journey down back into mids has been after maybe 12, 24 months. Typically there's been some pressure built from shareholders onto management teams around strategy, the shape of their business. So maybe that leads to a strategy refresh, a management refresh, a board refresh. And often that can be a bit of a catalyst by the time it comes back into mids for that turning point. So I think, those couple of factors combined always sort of seem to mean that you're going to have better than average growth and companies at a very interesting part of their life cycle, either shooting up or having that turnaround component.
Yeah, so you talked about the turnover there, and aside from that period that I mentioned earlier, historically, over the long run, small and mid caps have outperformed their large cap peers. So you touched on it there, but can it continue, I guess, is really the question from here.
Look, we really do believe so. We believe in a couple of very strong thematics. We are positive on global growth. And you can get exposure through mid-caps to that, clearly in a number of different ways, but one part of the market we think you do get that from is resources, for example. And why will mid-cap resources potentially grow faster than large-cap resources is because of their specialisation, in my view. So you don't have to buy the big, bulky, diversified miners. You can get the sector-specific, commodity-exposed names that you want. So if you want pure-play copper, for example, you can get Sandfire. And let's just look at the relativities and performance between Sandfire and the larger mining companies of BHP or Rio, for example. You've seen that Sandfire has clearly outperformed. It's been a stronger player. If you like rare earths, you can get Lynas and Arafura, for example. If you want lithium, which is really hitting a bit of a turning point now, Pilbara is the pure play as well. So typically, in my observation is that pure play names can re-rate a lot faster and they get more earnings, let's call it zing, as things turn, because they're not weighed down by sort of maybe a commodity or two that's not doing so well in a diversified house. So it's that pure play exposure, I think, particularly for resources, that can lead to a little bit more outperformance, if you like.
The fund, David, style-agnostic, so you're not hunting specifically growth or value. How does that flexibility help through the cycle?
It's a great advantage to us. I mean, let's just cast our mind back over the last 5 years. There's there's been a huge amount of change, right? From a macro perspective, record low rates into a really rapid rising rate cycle, for example, changing global trade dynamics as well. So being style agnostic, when rates are sort of lower or coming down, we can really lean into some of those growthier names that might be a beneficiary of that. Or when the top-down changes to rising interest rates, for example, we can pivot out of growth stocks into maybe more value stocks or stocks that might be beneficiaries of rising interest rates, for example. And now with a key differentiator, I think, for our mid-cap strategy is that we're not afraid to play in resources, as I just mentioned. And really, that's been a real bright spot in the market at the moment, particularly as we're starting to see a bit of a sell-off at the moment in tech names. We haven't managed to escape all of that, but we've been buffeted a little bit because of our positioning within the space of resources, which has helped. So it enables you to play in all different parts of the market at different points in time, and you don't have to sort of, cop an adverse macro event.
Just to follow up there, if I can, David, so not looking for specific numbers, but that ability to move the portfolio around, how much does it tend to move around? I mean, obviously not tipping out an entire theme or entire sector and bringing everything else in. So how much malleability, I guess, do you have?
Look, there's a bit, but look, yeah, we are mindful of turnover and what that might mean for our own clients around costs and the like to run the fund. And typically, what we do is we have the portfolio position to reflect our top-down views. Right. And then we pick the stocks from a bottom up. So we're really looking for the best neighbourhoods, if you like, in the city, and then the best houses within those neighbourhoods to populate the portfolio. It's maybe the analogy I like to use.
Yep, I like that.
And then it's really around, dialing those sectors up or taking them down a little bit as the macro scene may evolve over a 12-month period. So there will always be a couple of ins and outs. Index changes do drive that as well, I would say, from a mid-cap fund. But typically, there might be 3 to 5 in, 3 to 5 out in a year would probably be it, but then it's just dialing up and down the tilts, if you like.
Yeah. You've already touched on it, David, but I want to explore this theme a little bit more about it, the machine gunner versus the sniper and getting this targeted exposure. So you already talked about Sandfire versus BHP, but are there any more examples in the space or in the portfolio where you get that precise exposure that you want?
There's not really a theme, I think, that you can't get exposure to. I think one of the bright spots for next year, it feels pretty dark at the moment, but US housing exposure. You can get US housing exposure in mid-caps through RWC, through a plumbing supplies business, and also through Reece, which is a growing presence. Both stocks have been clearly under a lot of pressure, as has that whole sector. But you can really hone in on that US housing exposed names in mid-caps. If you want to play just domestic financial platforms, you can do that as well through a hub and a Netwealth, if you like. I've touched on resources being able to get that sector specialisation as well. If you want US consumer exposure, you can get that through an XYZ or you can get that through a Zip, for example. So, if there's a theme that you want to lean into, you can get that exposure through a whole multitude of different ways, but you don't have to buy a big diversified name.
The SMID cap universe, generally less research than the 50 and maybe even the 100. How do you go about finding those inefficiencies and then delivering alpha for your clients?
Look, we're really lucky at Ausbil. We've got a great research team full of sector dedicated analysts that are covering all stocks up into the ASX 200. So we're fully covered across the whole suite of stocks down to the 200th name. We've also, a key competitive advantage I'd like to think from an Ausbil perspective on mids is that we have a very successful small and micro cap fund. So the guys and we all work together side by side, see these opportunities very early on as they're in their micro cap stage. Often they'll get promoted into the small cap fund. It really gives me a great view on those mid caps of tomorrow as these guys are bringing these stocks through. And you can really see that being expressed in the mid cap portfolio that I run. There's probably about a third overlap between the emerging leaders mid cap fund and the small cap fund. So we're really trying to pick those mid caps of tomorrow early. And so it's really just, the breadth of research and the resourcing we have at Ausbil really gives us that edge, we think.
So you got the ones coming up from underneath and then you got the fallen angels coming from the top as well. You got it covered from both directions.
Hopefully, that's the idea.
Yeah, nice one. Looking ahead, David, opportunities in the SMID universe, 1 or 2 themes or sectors. You've already touched on a few, but stuff that you're really liking at the moment.
We'll just come back to that US housing exposed names in the top 100 and the 2 that are in the 50.
And is that more from a valuation perspective as well as a thematic? Because those stocks, like you said, they've sold off quite heavily.
They have. Look, the cycle's clearly been a little bit deeper, but we do think the cycle will start to turn next year. And partly the thinking there is we have had a softening in interest rates in the US. Mortgage rates are still maybe stubbornly a little bit too high, but what's coming out of the US administration at the moment is that they really want to tackle US housing. I'm sure they'd like to see a healthier and more active housing market leading into their midterms. We've already seen a couple of ideas floated, whether or not they're good or bad policy is yet to be determined, but for example, a 50-year mortgage has been floated in the US. Also, the portability of mortgages has been floated in the US. So now, these are very sort of, let's call it embryonic ideas, but I think gives you an insight into where the administration wants to go or what it's trying to tackle. And so we think housing activity in the US has the potential to pick up next year, and we're at a bit of a cyclical bottom, if you like. So in many respects, I think the US housing exposed names today feel like resources stocks did 9 to 12 months ago. So that's probably the area I'd like to hone in on for next year, or could be a story for next year.
Yep. Let's go a little bit deeper. So you talked about finding tomorrow's emerging leaders. What sort of factors, things that you look for in particular companies? And then can you give us a couple of examples of stocks that you think fit the bill right now?
When we're looking at those names that can really come through, it's really got to be the ability to compound earnings consistently over a 3 to 5 year period. I think that's obviously where the market gets a little bit excited. If it's a little bit too cyclical, it might not quite get into mids. It can be a moment in time, like gold, for example, is very strong at the moment. We've seen a huge elevation of gold stocks. But the stocks that are starting to come through, clearly Zip is one that's coming through. We think that buy now, pay later space in the US is still relatively embryonic. It is growing. It never really went away in the US. It kept growing, but there are lots of factors that were impacting the stock, in particular loss-making regions, which they've cut off. But that's one stock where we think they can compound earnings quite significantly over the next 2 to 3 years. So that's one we've been positioned in for some time, and that's likely to be an entrant into mid-caps, we think, potentially at the December rebalance.
Yeah. Any other names?
Another name that's coming through is Tuas, so the telco that's run by David Lloyd in Singapore. We think that's got a very long runway, and we do think they'll be successful with their most recent acquisition. There is some regulatory uncertainty currently, which is impacting the stock, but it's now back to prices pretty close to, if not below, the announcement of the merger, which we think will be highly earnings accretive and give the story another leg of growth. So that's another one that has been a favourite one in our small cap portfolio. It's more recently entered the mid cap portfolio on the back of this pullback. So that's another one we have high hopes for throughout calendar 26.
Dave's got a pretty good track record, doesn't he?
He runs a pretty tight ship. He's got a very good track record, and what he's building out there in Singapore, we think can continue to get bigger and bigger.
David, thanks so much for sitting down with Livewire.
Thank you, Chris. It's great to join you today. Thank you.
If you enjoyed this interview, make sure to give it a like, and don't forget to follow our YouTube channel. We're adding lots of great content every single week.